Mortgage Rates Live. Today we're going to go through some live mortgage rates like we do every weekday, and then we'll do a deep dive into a topic. And today's topic is going to be conventional Freddie Mac loans, taking it to some basics. In the meantime, we can put the chat up on the screen there. Feel free to drop a comment in the chat. We'll wait just a few minutes to get started here while we go live on all the different platforms. We are streaming live on YouTube, Facebook, Instagram, and LinkedIn. So give us just one moment here, and then we will go ahead and get into it. Hope everybody's been having a great week so far. Thank you for tuning in. Feel free to drop a comment there as you tune in. See, some people were already commenting there. All right. Okay, looks like we are live and good to go. So we will go ahead and get it started. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every day on this show is go through different live actual mortgage rates for today. And then we do a deep dive into a different topic. And today's topic is going to be conventional loans, specifically through Freddie Mac. So kind of taking it back to the basics here. Yesterday we did Fannie Mae. Today we're going to do Freddie Mac. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to talk about some different ways to approach Freddie Mac conventional loans. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and see what the actual rates are looking like this morning. So Nick, let's go ahead and pull up our pricing tool and see what the market looks like.
All right, let me switch my screen and we will get started. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates and APR, including all the fees for today, July 19th, just after 11 a.m. So most of our programs have new rates issued. So we'll use this tool to check those out and compare them. If you would like a full breakdown of all the fees that go into the APR, a full itemized loan estimate, please get with one of our team members. We have over 300 loan officers and are licensed in 24 states for primary and second homes, and can do our DSCR business purpose loans we love to do in 44 states total. So for today's demo, as we do every day, we'll set up a basic scenario, a loan amount of $400,000. We'll set the LTV to 80% loan, 20% down payment. We'll set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in cost, which is a typical request. We will check out our conforming conventional, which includes Fannie Mae and Freddie Mac, which is one of our topics today. Then we'll check out FHA, which is usually the next option for most borrowers. Then we'll go into expanded guidelines, also known as non-QM, which is our specialty there, where we have over 5,000 additional loan programs using alternative income. And we also offer VA and USDA. Remember, VA is only for eligible vets and active service members. If you are eligible, let us know. We'd be happy to quote it. And same with USDA, that's only for eligible properties in a USDA rural area. So if you do happen to be shopping there, let us know. So for the first demo, we will do conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single family home, 1 unit, state of Florida, county Miami-Dade. And for all of our demos, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with those settings, as we do every morning, let's check out the conventional options. So good. Looks like we got a little bit of downward movement yesterday. So 6.875, best option, 1 discount point in cost. Final APR just a touch over 7 at 7.042. So remember, the APR is the final cost. That includes all of the fees and everything. So this is what we use to compare across programs. So definitely good, lower than it was last week, which is also lower than it was the week before. So we love to see some downward momentum here. Now we'll use the APR to compare across the next option. If our customer doesn't qualify for conventional for any reason, typically the next option we always look at is an FHA program. So FHA, government program, does allow a little more leniency on credit type of issues, as well as a much higher debt to income ratio that we can use. However, for the demo, we'll keep everything else exactly the same. All we've changed is the loan type. That way we can compare apples to apples across the programs. So best option for FHA this morning, 6.125 rate, 0.875 discount points and costs, and a final APR of 6.713. So in this case, even with the mortgage insurance that's required on FHA, it's actually a touch cheaper if our customer qualifies for both. So definitely customers that qualify for conventional, I would definitely check out FHA. It actually might be a touch cheaper. And our customers that are required to use FHA, this is a great option. There has been some changes recently that are in our favor here. So a great option, so a little bit lower APR here. Now, if our customer for any reason doesn't qualify for either conventional or FHA, many other banks or lenders have no other options, but that's where we specialize here at the Mortgage Calculator, where we have over 5,000 additional options under expanded guidelines, also known as non-QM loans. So when we select this option, we'll keep everything else exactly the same, but now we have a new selection for income. So full doc is what we use for FHA and conventional. That's 2 years of tax returns, what most people are used to. So we will typically choose a non-QM option in order to take advantage of the alternates, such as asset-based programs, business bank statement programs. We have our investor programs we'll talk about in a minute. Our personal bank statement 12-month program, that's our most popular for a primary home purchase. We also have RSU, stated, VOE, 1099, P&L, and the elusive no income at all CDFI. So best option here that we typically use, the most popular, is the 12-month personal bank statement. And that's for our self-employed borrowers. Most of the times, our self-employed borrowers, when they submit 2 years of tax returns, might have different write-offs and may have a challenge qualifying for the income they really want, or even sometimes qualifying at all. So in this case, instead of using tax returns, we'll simply use their last 12 bank statements to determine a debt-to-income ratio of 40% in this example, using their actual cash in the bank, no tax returns involved. So most of the time, our self-employed borrowers qualify for double or triple the income using these methods, and therefore can qualify for the home they want. So we love these non-QM solutions. They're amazing solutions for our borrowers that might need a little bit of extra help. So let's check out the options this morning. So best option here at the top, 7.625 rate, 1 discount point in cost, and a final APR of 7.692. So remember the conventional was just a little over 7. Here, the non-QM, just a little over 7.6. So about a half a discount point difference in cost there to use a completely different income method. So a lot of great options here, very comparable programs. And you'll see we have a ton of different options to use. Bank statements, some of these programs, a little bit higher rates, may allow things like credit events like foreclosures and bankruptcies that would otherwise put us out of qualification. So not only can we get around the income, but we can also get flexible around other items with these non-QM programs. So please get with our team. They'll find the best one of these hundreds of programs that works for you. And before we go into Jose's deep dive, we always want to do live investor property rates. So for the next couple demos, we'll do investment properties. We love to work with investors, whether they're first-time investors or seasoned investors. We have some great options. So we'll set up the same exact scenario, 80% loan to value, 20% down payment, and we'll compare our investment property options. First, we'll check out conforming conventional. Then we'll go into our non-QM expanded guidelines options. Remember, the government programs, FHA, VA, and USDA, are not eligible for investment properties. So we'll select conforming first. Everything will stay the same as all our other demos. The only thing we've edited here is occupancy. Let's check out what the conventional programs have added for investment properties. So some good rates here, 7.125 rate for 3.875 discount points and costs. And that's a final APR of 7.387. So this is a good option for our borrowers that qualify for conventional full doc, but most investors would ask for a slightly higher rate in order to reduce these discount points. Here in this case, 3.875 discount points is $15,500. That's a lot of money that investors would typically like to use elsewhere, And if the property's making good rent, typically don't mind going higher in rate. Unfortunately, with the conforming Freddie Mac and Fannie Mae loan programs, there really is no options to go higher in rate. That's where we love to present our non-QM options. So for the final live pricing, we'll set up the same demo, investment property, ADLTV, and this time we'll select expanded guidelines non-QM. So first we have to pick our income option for non-QM. And our most popular for an investment property is going to be our investor DSCR program. That's because it doesn't actually require any income or employment from our borrower. We simply use the estimated rental income from the property to determine a debt service coverage ratio or DSCR value. So if the estimated rents can cover the mortgage expenses, the PITIA of the proposed loan here, that's a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. We even have options for ratios under 1.0 where the property doesn't quite cash flow on a monthly basis. So tons of different options. For the demo, we'll always put 1.5, which will show us all of them. And the final thing we need to select for a non-QM investment property is a prepayment penalty. So 3 years is what we use for all the demos. That's most common. There are options for no prepayment penalty that will cost more and limit the amount of loan programs we can find. And same with 5 years, that will limit the amount of loan programs, but will cost less and save our borrowers some money that want to hold those properties. So if that's the case, you can check that out. But 3 years is most common, so we can see all of the different options. So with these settings, let's check out the DSCR rates. So good option at the top here, 8% rate, 0.85 discount points in costs. Final APR just a touch over 8 at 8.062. So some good options here for no income, no employment, and we've solved our borrower problem of discount points. So instead of 15,000, 3,400 sounds like a much better deal. So we're able to go up in rate, lower those discount points, and no income, no employment involved. Our investors can do multiple loans, 1, 2, 5, 10 loans at a time because there's no income or employment needed. So these are very popular options. Most investors that see a conventional option that will have a slightly lower APR, but compared to the DSCR option with lower discount points but a higher APR, will typically choose the DSCR option. So definitely recommend our investors out there check out these DSCR programs. And as we scroll down here, there's dozens and hundreds of programs here. Some may have different prepayment penalty amounts. Some may allow foreclosures, some may allow bankruptcies, and some may allow us to use short-term rental income at the higher rate options. So tons of different flexibility we're afforded with these non-QM programs. Please get with our team to check them out. All right, so that's the end of our live rates. Let me go ahead and switch my screen, and we'll introduce Jose's topic for today. All right, so I'm going to pass it over to Jose here in a second, our 27-year veteran here. Very used to working with conventional loans for over 27 years, right? The different variations. Today we'll be talking about the Freddie Mac variations. So yesterday we went over Fannie Mae, which, every day we do the live pricer. That's a mix of all the conforming programs. Some days Fannie Mae is a little bit cheaper. Some day Freddie Mac versions are a little bit cheaper. So you see we have a plethora of programs, but they're all under the general umbrella of conventional or conforming when we do the live pricing demo. But obviously, just as we went over yesterday, there are a ton of variations besides the one simple demo we do every day. There's all kinds of special tips and tricks. There are special programs under certain income levels. There are special programs, obviously, for rehab and all this other stuff that we go over in other episodes. But today, Jose is going to go over some basic differences in the Freddie Mac version of conventional versus the Fannie Mae version of conventional that we went over yesterday. So tons of cool stuff we went over yesterday. And Freddie Mac has just a slightly different version of all basically the same cool programs. So Jose, I don't know exactly which demos you have, so why don't you just introduce them and then we'll pull up your live demo.
Good morning, everybody. Thank you for joining us today for Daily Rates Live on the Mortgage Calculator. It's great to be with you. Freddie and Fannie are both our conventional / conforming loan conduits. However, the reason that we would choose one over the other is usually not going to be about the interest rate, even though that's what your novice MLO may think, because there sometimes are a little bit of a variation in the rate between one or the other. Now, obviously, sometimes you're running your automated underwriting. One reason may be you don't get an approval on DU or DO, which is the Fannie Mae version of automated underwriting. And then you try LP, which is Loan Prospector, which is a Freddie Mac version. So that's another reason why we may choose Freddie over Fannie and vice versa. However, as I state in my trainings that I give loan officers, there's two very significant differences in the guidelines between Fannie Mae and Freddie Mac. Significant differences that may result in your borrower qualifying or not based on the scenarios, right? Same exact scenario would be viewed two totally different ways. The first scenario has to do with student loans. Fannie Mae on specifically deferred student loans, which, as you know, pretty much every student loan, almost every student loan in the country right now is deferred still due to the pandemic, right? So the first difference is that Fannie Mae treats the deferred balance, which you would use to calculate the monthly payment that has to be allotted to that deferred balance, because you don't leave it at zero, even though the credit report may not show a payment because it's deferred. We still have to enter a payment in our application. For the Fannie Mae loans, we use 1% of that deferred balance as the monthly payment. So let's use the example of $100,000 in student loans, which by no means is an out of the ordinary figure. So $100,000 deferred student loan on a Fannie Mae loan is $1,000 a month liability that you have to put on the application. And for Freddie Mac uses 0.5% of the total balance of the total deferred balance as a monthly payment, which is $500. So you're looking at 100% difference between one or the other. So $500 is a lot of money to put into the DTI simply because maybe you didn't know the difference, right? So that's one key component. The other key difference, one that is the real mind blower, has to do with self-employed borrowers, specifically our self-employed borrowers that could be participating in an S corp, or could be participating in an LLC partnership. So they may get a Schedule C. But it has to do with the income for those S corp borrowers and what is being claimed as ordinary income, which is usually line 1 on the Schedule K, and what is being actually pulled out of the business through distributions, which is box 16D as in dog in the same Schedule K. Fannie Mae requires you to use the lower of the two figures, right? So you could have the borrower, in our example here now, the borrower claims $100,000 in ordinary income on the Schedule K. That's what he says he's making, and that's what he's actually paying taxes on $100,000 in income. But the borrower only distributed $20,000. Well, if you're using Fannie Mae guidelines, Fannie Mae requires you to use the lower of the two figures. So that borrower's income would be, are you ready? $20,000, not the $100,000 that the borrower claimed on the Schedule K. So you're saying, well, that's not fair. Well, that's the guideline, right? However, Freddie Mac has a workaround, right? The same $100,000 in ordinary income, the same $20,000 in distribution. Freddie Mac states if the business has liquidity, which equates to assets greater than liabilities, and there is a liquidity calculator that Freddie Mac has as part of their worksheets. You have the, I think it's the Freddie Mac, you have the Freddie Mac, I think Form 91, which I think is what the number for their income calculator. And then they also have a liquidity calculator where you plug in the information and you see if the business has liquidity. And obviously, it has liquidity if there's a positive number at the end of the calculation, which means assets is greater than liabilities. The business has liquidity. And if the business has liquidity, Freddie Mac lets you use the $100,000 that the borrower is claiming as ordinary income instead of having to use the $20,000 that the borrower actually distributed or withdrew, because that's what a distribution is. They are basically taking money out of the business. That's how self-employed borrowers take money out of the business, unless it's a W-2 earnings that they're paying themselves. Any money that they draw out of the business is categorized as a distribution. So you can see that if you do not do your homework in properly structuring the file, you could inadvertently cause a file to be denied if you went the Fannie Mae route, uh, and the borrower didn't distribute as much as he was claiming in ordinary income versus going Freddie Mac route, where if they have liquidity, the borrower will qualify. Hopefully, you did your numbers based on the $100,000. So those are the two main reasons that you would choose Freddie Mac over Fannie Mae. That, and then obviously what I mentioned previously, I have seen cases where the algorithm is a little bit different for how it reviews the credit and how it reviews the income. Also, one other difference in Fannie Mae over Freddie Mac is that Freddie Mac will stipulate automatically in the findings that for a self-employed borrower, if the business has been established for 5 years or greater, you only have to use 1 year's the most current tax return. Fannie Mae does offer the 1 year option, if you remember from yesterday's show, but it is not written into the guidelines how it is in every LP approval. Every LP approval will automatically state for a self-employed borrower, if the business has been established more than 5 years, you can use the 1 year tax return. Uh, but Fannie, you have to obtain that option, and it's going to look at the risk associated with the file. And if it's low risk, it's going to give it to you as well. So, and I've seen other cases where just in other types of deals where same deal is put through Fannie DU or DO, doesn't get the approve eligible, but it's put through LP and it gets the accept, which is Freddie Mac's version of approve eligible. So that's the differences why you would use one over the other. So now let me give you some of the options here that we have for the quotes. Similar quotes to the ones that I provided yesterday, because so you can see that all these great options are still available. So we have our first time home buyer, 1 unit purchase at a 97% LTV with reduced MI. At 3% down, you're talking an MI factor of 0.25, which is normally an MI factor that you're going to find on conventional loans at a 90% LTV. So you can see how you do get a big benefit on the LTV, and you also get reduced rates. Look at right here. I mean, we can go, and again, our 3% down borrower may need a little extra assistance with their closing costs. So note that how much of a lender credit option we have here, right? We have 7.125, and this is so I can show you a scenario here, $485,000 loan on a $500,000 purchase. 7.125 will give us a lender credit of $3,880, which could definitely assist your borrower with some of their closing costs. And if your borrower doesn't have an issue with the closing costs or with funds to close, they can buy it all the way down to 5.75, and that's 2.5 points it was on the example, $12,125. Slightly lower than conventional rates, where I just locked in a file very recently at 5.75 at a 48% LTV with a 770 credit score, and the borrower had to pay 3 points. So you can see here at a 97% LTV, paying 2.5 points for the same rate is a great deal. And on top of that, you get reduced MI. So now Another cool option here is a 2 to 4 unit property purchase, the ultimate house hack. We always recommend, if you are a first time home buyer, you do not own any other properties, you should consider trying to buy a 2, 3, or 4 unit property, because this is probably going to be the only opportunity you're going to have to buy the property with such a low down payment. FHA does offer 96.5%, and this one is a conventional loan, which is, in the mindset of the market, a little easier to get a conventional loan offer accepted than an FHA loan offer accepted. So if you're in that market, you should consider obviously getting pre-approved if possible for a first-time home buyer. 3 or 5% down option. And this option here is for a 4 unit and a 95% LTV. And again, 95 is the max LTV when it's 2 to 4 units. And again, you're looking at the 7.125 rate and a 95% LTV with a $3,800 lender credit. And again, being able to buy it all the way down to 5.75, a little less expensive than the other option. I believe this one's 2.375 instead of 2.5 points because it is 95% LTV. Freddie Mac does also offer renovation loans for purchases or for refinances. This is a purchase option at the max LTV of 95%. Here, our lowest cost option is 7.75%, and our lowest rate option 6.75%. Now, mind you, for this borrower that in this example that has an 800 credit, we will probably get 2 bona fide points, and we would probably be able to buy it down further than 6.75. Obviously, the borrower would have to pay more points, but this was a cost of 2.375 points at this rate. So if we get our 2 bona fide points, we could probably buy it down to like the low sixes or maybe 6% or something like that. It's probably going to cost like 3 and a quarter points, but we would still be in compliance with the lending laws. And then, last but not least, I was talking about our self-employed borrowers and how cool Freddie Mac treats those borrowers. So here again, our lowest cost option, 7.375 with a lender credit. 7.25 is our par rate. And we can buy it down to 6.125. And like I just mentioned, regarding compliance, with such a great borrower with a high credit score, due to the fact that we would probably be able to buy it down a little bit further if once we ran the compliance test, if we would be able to get 2 bona fide points, and we could probably buy it down into the upper to mid 5% range for the borrower that expects to be in that house for a long time, doesn't mind paying the extra cost to buy down the rate. So very good options here for our self-employed borrower that would probably get the 1 year findings in Loan Prospector.
All right, great. So different ins and outs there. Always great to know. It looks like there is one question. I'm not sure exactly what it was asked, though, there from Joe.
That was Jose. On the differences of the LLC. So, yeah, Jose knows what it is.
Yeah, regarding the liquidity percentage or dollar amount, there's no minimum. It just has to be a positive number. As long as it's a positive number, assets greater than liabilities, the business is considered to have liquidity. And the rationale here is that if the business has liquidity, the business has money, right? Because remember, we're showing ordinary income of 100,000, but you only withdrew 20,000. So what Fannie Mae's rationale on that is, hey, maybe you didn't withdraw the full 100,000 because you don't have liquidity. So they just automatically go for the worst case scenario. Whereas Freddie Mac says, you know what? We're going to give you a chance to prove your worth and show that you do have liquidity. So show me the liquidity. And if you can show them the liquidity, then they will let you go with the higher income amount.
All right. Looks like Nicole has a question as well. What is the difference between the conventional renovation loan and the FHA? She said streamlined, but meaning 203K. She corrected herself. So, what's the difference between the FHA 203K and the conventional renovation loans?
I mean, do you want to answer that, Nick?
No, I was gonna say, good question.
Well, this is not so much about the renovation portion. It's just the underwriting of the borrower. Because remember, FHA is going to underwrite to FHA guidelines, which is going to be FHA credit guidelines. And the conventional loan is going to underwrite to conventional guidelines. FHA has an upfront mortgage insurance premium, right? 1.75% of the loan amount is an additional expense that the borrower is going to incur, which is going to be financed into the loan, right? So that's one option there. That's one issue there that's going to increase your debt automatically for the FHA loan. The FHA mortgage insurance, unless you start with a 90% LTV or lower, at which case you can, when you get to 78% LTV, you can eliminate the FHA mortgage insurance. But otherwise, if you start at 90.01% or higher LTV on the FHA loan, the mortgage insurance is going to stay with the loan for the life of the loan. It's just going to decrease over the life based on the balance, right? So as far as the actual renovation part of the guidelines, there's not much difference. Those are limited. It's not a ground up construction. What you're doing here, you're looking at having to work with the established foundation of the property. They don't really want you adding on like bedrooms and stuff like that, because if you're adding, as long as you're working within the space that you have, converting a garage legally into additional living space, you can do that. But they're not really going to, for these limited type programs, want you adding like a half a house, stuff like that. So the reason you would choose one or the other is really going to be, do you qualify for the 203K, or do you qualify for the conventional renovation loan? Some people don't qualify for the conventional loan, and they have to go for the FHA option.
So in other words, it's typically income-based or liability-based, which are the differences that we went over. Remember, FHA uses student loans at the lower factor, right? So FHA and Freddie Mac use the lower, Fannie Mae uses the higher. So if student loans are your issue and you're going for renovation, you're going to lean towards the FHA or the Freddie Mac. The Fannie Mae is not going to be a good option for you. So it's more so, like Jose said, of the general, if this borrower was buying a brand new home regardless, what would you do? Then you would go with the renovation of that program, right? You want to make sure the borrower gets the best program that they qualify for. The renovation is going to relatively be the same across programs. Okay, Nicole's got another question here. Jose?
Nicole's question is, can borrowers use the conventional renovation loan for an investment?
That's good. I mean, you're not, it's a little tricky. So it's in the guidelines, but you have to find the lenders that offer it, and the pricing is going to be insane. So the high LTV won't be an option. And I think what's the highest on that option? And it's only, it's not, obviously FHA is not an option, but the Freddie and the Fannie both do, I believe, have a limited option. The LTV is different and all that. So just make sure that you check, especially at the max LTV that it's going to offer. There's no way it's going to compliantly price because of the additional adjustments that we go over every day on all the adjustments for investments, right? How they're just really crazy right now.
I have the answer for you.
Okay.
85, because I just did a quick little search here on our CRM. You're looking at 85%.
But the pricing's probably not compliant at 85, I bet. Click through the pricing. You found one?
No, but I will set up the LTV at 85% here a minute.
I think that would be your only challenge there, Nicole, is it is possible. It's just you got to find a lender that does it. It's a little riskier. And then we also going to have to find a compliant price, which I bet Jose's having that challenge right as we speak.
Yes, correct. 4.5 points is the least expensive cost that I have at an 85%. So Guidelines say 85%, but you're probably looking at 80%, which is
Probably even 75. I bet you're still going to cash out at 80, run out of room there.
Yeah,
At least to be safe, unless we get some bona fides.
Yeah, exactly. I have it here at 80%. The least expensive option is 3.5 points.
Which
So
we
I guess
we can't price necessarily without making sure we have some bona fides. That would usually exceed our limits unless there are bona fides, and we would just have to run some compliance tests on that. So typically, you would just need to be very careful when you're pricing those higher LTVs on anything higher LTV, right? Right now, unconventional is going to possibly hit some of those limits, especially second homes, guys, too. Second homes are really hard on those higher LTVs as well.
So I did get on a Fannie Mae option at a 75%. We do have 7.625 costing 1.875 points on the investment renovation for a 1 unit, and that's 75% LTV. So that
would be
highest.
A realistic option right there. I think that you should shoot for, and you probably get it. Yep. Good question.
All right, cool. So some great questions there. Appreciate that. Remember, we do this show 11 a.m. Eastern time every single weekday where we go through the different live rates and then do a deep dive into a different topic like we did today with the Freddie Mac Loans. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.
Thank you, everybody.